Jeff, let's talk about our next topic here, and that is sequence risk. Fix it by separating cash flow from growth. The market's been strong lately. Why is now the time to talk about retirement risk and sequence of return risk, do you think?
Well, I mean, that's part of what we build into our plans. You know, if you are retiring tomorrow and the market corrects 50% in the next 2-3 years, or even in the next 6 months, because we're probably due for a big correction, we can't rule it out. It could be that big. Some people say, oh, it won't happen this time. Those are just things of the past. Well, they're things of the not too recent past. We've had 2 market crashes of more than 50% just in the last 25 years. And we're overvalued to a higher extent than we were at that point. If you look at history values and the fact that the market always returns to some sort of equilibrium value. You know, if you look at fair market value being about half where it is right now, we could very well have the market tank. Now, if you are 10 years from retirement, you should welcome such a thing because you can buy for the next 10 years at a reduced rate and actually have more money than you would if you just stop investing. If you have already made a bunch of money, given the fact that the market is at an all-time high or near that, every market correction, every big crash and every little crash came after a recent all-time high. So keep that in perspective. Just because it's an all-time high doesn't mean it's going to stay there, because there's always been all-time highs before any big market correction or a crash. So, and I'm not calling for a crash. I'm just saying we have to be aware of it. Yeah, I've been saying this for a few years. I actually thought we were a lot more close to it a few years ago when those policies were causing a lot of inflation, money printing and things like that. There was obviously some inflationary things going on. They were kind of trying to fix the market with interesting means, but it did finally correct. There was so much money out there that people just bought it up and we kind of weathered that storm. But now that we have a little bit more clear indication of where the money's going and there's a little bit more, I guess we're getting tipped off a little bit more easily with the Trump administration. We've been able to do a little bit better with market picks and our market confidence. But nevertheless, you still have to respect the fact that it can correct any time, that there's not a guarantee that you can get out in an hour or a day or in the week that it crashes, or if there isn't some huge 9/11 type event where the market just shuts down, you don't have a choice. You have to wait it out and see what happens. So there are some risks that we can't control. And if you're retiring just right at a point where, let's just say your goal is to have $2 million saved that you can convert into $100,000 roughly worth of retirement income, and all of a sudden the market gets whacked and it goes down 10 or 20%, you say, well, that's okay. I'll wait till it comes back. If you're starting to spend money in retirement, you're going to lock in those losses. That money isn't going to come back. So if that sequence of returns, if the sequence is a bad start right out of retirement, then you stay at a bad start. That's kind of like your new start point is less. And if the market continues to go down, let's say it is a 50% market correction, we've had those, then you have $1 million and now you can only live on $25,000 extra per year than the $50,000 you thought you were going to live on. That's $2,000 a month that you don't get to spend. And you're kind of locked into that because money that you spent isn't going to come back. And if you retire right at the peak of the market in the dot-com bubble and it blows up and you're spending money, that money doesn't recover. You have to get jobs. You have to take Social Security early. And then if you finally start getting that money crawling back little by little, but keep in mind for the last few years you spent money, that money might make up a third of your assets perhaps. Well, that's a third that doesn't grow anymore. That's a third that doesn't last 20 or 30 years to cover your expenses. Inflation comes along. The only thing you get a cost of living adjustment on is your Social Security. And you can't raise your income because you don't have enough money there anymore because the market corrected early on in your retirement. You know, let's say you have a couple $1 million and the market has already crashed because you used to have $4 million. Well, then you still better make your plan based on the $2 million that you have left. I wouldn't go back and say, well, yeah, but I had $4 million. It's going to come back. You have to really base it on where it is at that point. So if you retire when the market is fairly valued or low valued, you can have a better level of confidence knowing that when you do pull money out of those assets, you're less likely to have a big hit or a big loss. But I think going into the market right now and going into retirement right now will be a little bit scary for anyone that knows that the market is historically overvalued and could crash. And if you have to use that asset for living on, then it's a bad thing. And that's why we say, take the profits off the table. You've done really well. You can actually get a premium for all your investments right now. You can actually get more than they're worth. It's like you have a house that's worth $500,000 and somebody offers you $700,000 for it. Would you not take it? Well, no, I just want to live in my house. Okay, well, then you just want to keep your stock. Well, that's fine. If that stock you're not going to need to use to live on, it's a different story. But when you get a chance to get a premium, sometimes it's great to just take profits and be happy. You take those profits and you put them into assets that will guarantee income. More income, in fact, than the 4% rule that Wall Street has always touted as being the rule of thumb, which is kind of weird since the stock market averages 10%, bond market averages 4 or 5, and yet you can only take 4% out. Well, that obviously reiterates the fact that there's a return or a sequence of return problem, and volatility hurts an income plan more than it hurts a growth plan. So get your stocks and bonds during the growth phase and get your income plan and protect those assets during the income phase. That's what we do. We have to use insured and secured products built for income. Unfortunately, Wall Street doesn't seem to sell them. They don't have anything. They could sell you a bond that says, oh, it has a dividend or it has an interest rate of this, but that interest rate or that dividend can change any time. The stock market crashes, you lose half your value on the dividend stock. Oh, and the dividend percentage acts like it goes up, but then they readjust the dividend percentage down to where the stock value is, and then all of a sudden you're getting half the money you thought. And if you need to sell that stock for any reason, you get half the money that you paid to buy that stock. And I can show you several dividend stocks that have done that over the last 5 or 10 years, that they've gone down just as much of the dividends. So you really haven't made any money. You've just been kind of holding your money flat and haven't been making enough to supplement your lifestyle and supplement the income that you need. So again, sequence of returns is a big deal. Right now, we're looking at an event that could cause a bad sequence of returns, meaning that we could have a down year. And it kind of depends on whether you retire in an up year right before a down year, or if you retire in some down years right before a few up years. If you retired in the year 2003 after the market was down, you had $1 million, you sure did a lot better on that over the next 10 years, even with the market crash in '08, than you would have done if you retired in 1999 or 2000, like the story that I tell about Norm. Norm is a real person, and he worked for a chip company up in Phoenix and made a good living and thought he'd have a good retirement. And unfortunately, he didn't. He lets me tell the story because I couldn't actually help him. He dug too big of a hole. His retirement plan failed. He pretty much died on the retirement mountain, so to speak. I told him I really couldn't dig him out, but I wished him the best and asked if I could share his story. And he said if I thought it could help people, then it was fine. So I have been telling that story. So sequence of returns is real, especially when you're looking at a multi-decade of retirement. Most people aren't going to retire at 60 and die at 70. They're going to retire in their 60s and die in their 90s or 100. Who knows? That's, a potential 30 or even a 40-year retirement plan that you need to have everything you worked for 30 or 40 years become and create income for the next 30 or 40 years. You don't have a job creating new income anymore. You have to use what it makes, and you cannot afford losses. You can't afford to lock in those losses. Sequence of return is a real thing, and it will wipe you out if you don't set some of your money aside in some principal protected account that you can use for income while the market recovers and while you have to wait on those market assets to get back and start making money again. So again, it's not really rocket science. It's just looking at the math and looking at the volatility, looking at history, and putting some scenarios together. We use a spreadsheet where we can show you different scenarios. We can plug in different what-if scenarios and show you what would happen if the market crashed. Would you actually still have money when you're 90? If you put some in a protected account that only made 6% and the market crashed, would you still have money in your 90s? The answer would be like, wow, way more than if I lost half of it in the next market crash, even though the market might average 10% or more. The last couple of years, it's done very well, but add 2022 in it, it's not done that well. If you add this year into it, so far we're down. Hasn't done that well this year. It might end up not doing well this year, especially if we have a protracted war in Iran and other things start happening in the homeland, or who knows? Nobody knows the future. Nobody has a crystal ball. And that's why you need to plan for the worst, hope for the best, but plan for the worst just in case it happens, because it never broadcasts when it's going to happen. It just happens. The market does what it does. The market does what it needs to do, but it never tells us when it's going to do it. We can guess. And a lot of people have been really lucky guessing, and they made a lot of money by, being considered gurus because they guessed. But you're only as good as your last guess, and nobody knows whether the next guess is going to be right or wrong. So plan for any situation. And as long as you can handle the good markets and be happy, and also handle the bad markets and be happy, have all your bills made, and not have to rely on that market-based asset bucket that is getting hammered in bad times, then you'll live a longer time. You'll have less stress, probably not shorten your life expectancy by extra stress that some people, I think, go through when they have everything tied to the market. So it doesn't have to be a lifestyle change. It has to be just a commitment to confidence and a commitment to a plan that makes sense and protects during these times.